1 in 2 households with a mortgage was left in the red last month.
Australia's housing market is breaking down, and it's happening faster, deeper, and more quietly than almost anyone is ready to accept. For years, Australians were told that the market was strong, that the fundamentals were solid, that demand would always outpace supply, and that prices would always continue to rise. But now, something is shifting beneath the surface, and the shift is big. Right now, millions of Australians can feel it. Not through headlines, not through government statistics, but through their own lives. Through rising bills, impossible rents, collapsing builders, and mortgages that suddenly cost far more than they did just a year ago. It's like waking up one morning and realizing the ground under your home has been moving for months without you noticing. For a long time, the warning signs were there, but they were easy to ignore. People were too busy focusing on work, family, daily life. Most households didn't think about interest rates or construction pipelines or global supply chains. They just paid their bills, followed the news occasionally, and assumed everything would balance out eventually. But this time, it didn't. This time, everything hit at once. First came the interest rate shock. Across the country, millions of Australians watched their mortgage repayments jump dramatically. Fixed-rate borrowers who enjoyed exceptionally low rates were thrown onto variable rates that doubled their monthly costs. Some households saw increases so severe that their financial plans built carefully over years, collapsed instantly. But even when the rate rises stopped, the pressure didn't ease. The damage was already done. Family budgets that were once stable were now stretched so thin that even small changes in expenses pushed people into stress. It wasn't just the mortgage, it was everything around it. The cost of living crisis arrived at the worst possible moment. Groceries went up, fuel went up, utilities went up, insurance went up, rent went up. Everyday essentials that Australians took for granted suddenly became harder to afford. And when your mortgage payment has already doubled, every increase in living costs hits harder, much harder than it ever did before. And then came something that very few expected: the collapse of the building industry. Thousands of construction companies across Australia failed. Not because of demand was higher than ever, but because the financial foundation of the building sector had been quietly weakening for years. Material prices skyrocketed. Labor shortages caused delays. Fixed price contracts became traps that companies couldn't escape. Even strong builders with decades of experience found themselves overwhelmed. Every time a building company collapses, the impact spreads far beyond that company's office. It hits the families waiting for their homes to be completed. It hits the broader housing supply. It hits renters who rely on new properties to ease competition. It hits investors, banks, and entire communities. And this pressure is not stopping, it is accelerating. Australia's housing system isn't just struggling in one area, it's being squeezed from every direction at once. Repayment shock, cost of living, building collapse, population growth, rental shortages, shrinking supply, falling affordability. All of these things are happening simultaneously. And that's what makes the current moment so dangerous. This isn't a slow-moving crisis. It's a silent tightening, a pressure that grows a little more every week, a little more every month, until families begin to feel it, not as a number on a chart, but as a constant presence in their lives. People are starting to feel tired, stretched, worried, unsure how long they can keep going like this. And yet, the most concerning part of all of this is not simply what has happened, but what is building underneath, quietly, without much attention. Because behind the public discomfort and the rising stress levels, something deeper is happening. Households are running out of buffer. During the pandemic, savings rose. People had extra money. Stimulus payments helped. Spending slowed. But today, almost all of that financial cushion is gone. Savings accounts are shrinking or empty. Emergency funds are being used for everyday bills. And when millions of people lose their financial buffer at the same time, the entire system becomes fragile. Fragile systems don't break in obvious ways at first. They don't explode. They crack quietly. Households begin cutting back on everything except the essentials. They reduce spending, delay repairs, cancel family activities, and live with more financial anxiety than ever before. And when millions of people do that simultaneously, the broader economy begins to slow down too. But one of the biggest sources of pressure, and one of the clearest signs that the housing market is breaking down, is the rental crisis. Rents have surged at some of the fastest rates in modern Australian history. Vacancy rates are so low in many regions that they're effectively zero. This means that people aren't choosing between good and bad rentals. They're choosing between something barely affordable and nothing at all. Families are competing with one another for basic shelter. Students are sleeping in cars, on couches, or in overcrowded rooms. Workers are commuting hours each way because they can no longer live near their jobs. And every month, more people are being pushed into harder and harder situations. This rental crisis didn't come out of nowhere. It was building quietly for years, hidden by the illusion that supply would always meet demand eventually. But demand didn't slow down. It exploded. Australia's population grew far faster than its housing supply. Hundreds of thousands of new people entered the country in a very short period of time. Far too many for the existing housing stock to absorb combine, that with the collapse of builders, and the result is extreme pressure. More people, fewer homes, higher competition, and skyrocketing rents. This is the point where the crisis begins to loop into itself. The point where one pressure makes the other worse. High rents push people away from saving for a deposit. Lack of deposits pushes more people into renting for longer. Longer renting increases competition. Competition raises rents even more. Higher rents push savings down further, and the cycle continues. And while this cycle spins, interest rates aren't dropping quickly enough to relieve the pressure. Financial institutions warn that rates may need to stay elevated longer than expected. Even a pause, or small cuts, won't reverse the damage already done. Households are already in survival mode, and survival mode doesn't disappear overnight. Perhaps the most dangerous part of the situation is the silence. Many families don't talk about their financial stress openly. They hide it. They downplay it. They hope things will improve. They avoid worrying their loved ones. But the pressure keeps growing. Quiet stress becomes quiet cracks. Quiet cracks become quiet emergencies. And quiet emergencies eventually become loud problems. Right now, Australia is sitting on a housing system where millions of people are barely coping. And what comes next, the next 12 to 24 months, will reveal just how strong or how fragile the system truly is. This story is only beginning. As pressure builds across Australia's housing market, something unusual is happening. Something that even analysts didn't fully expect. People are beginning to change their behaviour in ways that reveal just how much stress the system is under. It's subtle at first. Fewer auctions, fewer bidders, more withdrawn listings, more price reductions. But when you look closely, the pattern becomes impossible to ignore. Buyers who once competed aggressively for homes are suddenly stepping back. Not because they don't want to buy, but because they simply can't. The numbers don't add up anymore. Even with a decent income, even with two people working, even with careful budgeting. The leap from renting to owning has become too big for many to make. The gap between aspiration and reality has widened to a level that feels almost cruel. Sellers are beginning to sense this shift. Properties that once sold in days now sit for weeks. Agents who previously promised unprecedented demand now talk about challenging conditions. And homes that were once considered almost guaranteed investments are starting to lose their shine. Quietly, beneath the surface of public optimism, confidence is slipping.
Nationally, just under 1,900 auctions, and a little over 60% of those were successful.
This softening is more than a seasonal slowdown. It's a symptom of a system straining under accumulated pressure. When interest rates rise this fast, when the cost of living surges, when the rental crisis becomes severe, and when construction fails to deliver new supply, buyers become hesitant. Hesitation turns into caution. Caution turns into withdrawal, and withdrawal turns into falling demand. But even as demand cools, prices remain painfully high. This disconnect between what homes cost and what people can realistically pay is one of the clearest signs of a market in breakdown. A healthy housing system adjusts. Prices rise and fall with demand. But a stressed housing system gets stuck. Prices stay high, not because people can afford them, but because supply is so tight that even weak demand keeps the market inflated. This is the trap Australia is in right now. A market that's too expensive for buyers, yet too undersupplied to fall dramatically, at least for now. Meanwhile, landlords are facing their own form of pressure. For years, investors were told that property was safe, reliable, and always profitable. But rising interest rates have flipped the equation. Many landlords can no longer cover their mortgage repayments with rent. Even with rent increases, the math doesn't work. What happens next is predictable. Some investors raise rents aggressively, pushing tenants to breaking point. Others sell. And when investors sell, renters lose supply, and competition intensifies. This feedback loop, stressed buyers, stressed renters, stressed investors, isn't just a sign of a downturn. It is the anatomy of a housing system under deep structural stress. One of the most telling shifts is happening in regional areas. During the pandemic, thousands moved away from cities, chasing affordability and lifestyle changes. But now, many of those places have become even more expensive than the big cities once were. Local incomes haven't kept up. Infrastructure hasn't kept up. And when rates rose, the financial cushion that many regional buyers thought they had simply evaporated. Some regional markets are now among the most vulnerable in the country. Vulnerability doesn't always show up as price crashes. Sometimes it shows up as slower sales, desperate sellers, rising arrears, and communities stretched to their limits. In these areas, the cracks are not theoretical, they're visible. Yet the most dangerous pressure point remains mortgage stress. Not because it's the most dramatic, but because it spreads silently. A household under financial pressure doesn't announce it. They don't post about it. They don't talk to friends or family. They hide it. They cut back quietly. They sacrifice quietly. They hope things will get better quietly. And all the while, the stress grows. When hundreds of thousands of households experience this at the same time, the entire market becomes fragile. A fragile market does not need a major shock to fall. It only needs time. The signs are already emerging. Higher arrears, more late payments, more hardship requests, more refinancing attempts, more borrowers extending their loan terms just to stay afloat. These actions don't appear in dramatic headlines, but they reveal a population trying to hold everything together with less and less strength. At the same time, the construction pipeline continues to collapse. New home approvals have fallen sharply. Developers are delaying projects because costs don't make sense. Builders are refusing fixed-price contracts. And even when projects begin, delays stretch for months due to labor shortages and material constraints. What this means is simple and frightening. The homes Australia desperately needs are not being built. And even if demand cools for a while, the long-term shortage will remain, ensuring that the market stays unbalanced for years. The imbalance creates a strange paradox. Prices are too high for buyers, but supply is too limited for prices to fall significantly. For now, renters are struggling, but landlords are also struggling. Builders need more projects, but can't afford to take them. Buyers want homes, but can't afford them. Population rises, but housing doesn't. This paradox is the core of Australia's housing breakdown, a system that can't move forward, can't go back, and can't stay where it is. Meanwhile, Australians are changing how they think about housing. Young people, in particular, are beginning to accept something that once felt impossible, that owning a home may no longer be part of a normal life path. It's a cultural shift that quietly reshapes families, relationships, career choices, and long-term plans. And it has real consequences. When a generation stops believing in the possibility of home ownership, the entire economic foundation of a country changes. older generations are also feeling the pressure. Many who once planned to downsize now worry they won't afford rent or strata costs if they sell. Others rely heavily on the value of their home as their retirement plan. If the market falls, their financial security falls with it. Even those who bought decades ago aren't immune. Higher living costs hit everyone. Insurance premiums have risen dramatically. Maintenance costs are higher. Property taxes and council rates continue increasing, and landlords are being squeezed from all sides. In this environment, confidence is disappearing, not overnight, not suddenly, but gradually, quietly, steadily. People aren't sure what to believe anymore. They don't trust the assurances that everything is fine. They don't trust predictions of stability. They can feel the pressure in their own lives. And when a market loses confidence, truly loses confidence, the real decline begins. Not the sharp drop of a dramatic crash, but the slow erosion of a system that can no longer support itself. Underneath all of this, one truth is becoming clearer every month. Australia's housing system was not built to withstand this kind of stress. Not this combination of pressures. Not this level of demand. Not this speed of change. What comes next will not be easy. The truth that Australia is beginning to face is uncomfortable. The housing market isn't just under pressure. It's fundamentally changing. And the change isn't temporary. It isn't a short-term cycle. It isn't something that can be fixed with one policy decision or one interest rate cut. It's deeper than that. What's happening now is the restructuring of an entire system that has been stretched far beyond its limits. For decades, Australia relied on a simple formula: population growth, rising demand, limited supply, and cheap credit would push property values higher year after year. It worked until it didn't. Once interest rates climbed, once supply collapsed, and once the cost of living surged, the entire foundation began to shake. And when a foundation shakes long enough, things start to break. Some of the first visible breaks are happening quietly in suburbs that once experienced relentless price growth. Homes that used to sell instantly are now struggling to attract buyers. Owners are reducing their asking price. Investors are cashing out, even if it means accepting smaller profits. And buyers are pulling back, looking at the numbers and realizing that the dream they once had is now out of reach. But beneath those visible signs, there are deeper ones. The kind that reveal the true stress of a nation. Families that used to feel financially secure now live with a constant sense of uncertainty. Renters who once hoped to buy now can't imagine it. Investors who built portfolios over 15 or 20 years are suddenly wondering whether it was all worth it. Older Australians who once planned their retirement around home equity now worry what a downturn could mean for their future. A housing market doesn't break because of one event. It breaks because pressure accumulates slowly, then all at once. Rising rates, rising rents, rising debt, rising costs, it's the combination that matters. And the combination Australia is experiencing right now is unlike anything in recent memory. Households are cutting deeper than ever before. Dining out, gone. Holidays, gone. Repairs, delayed. Savings, drained. Even basic essentials are being rationed more carefully. When millions of people adopt survival mode simultaneously, the psychological impact is enormous. A financial system isn't just numbers, it's emotion, confidence, belief, trust. And when those things fade, everything else follows. Even analysts are beginning to shift their tone. For months, many insisted the worst was behind Australia. But now, more and more experts are voicing what regular people have felt for a long time: that the pressure hasn't peaked, that the system is still tightening, that there are more difficulties ahead before things get better, and that certain regions, certain suburbs, and certain demographics will be hit harder than others. One of the biggest unknowns is how long interest rates will stay high. Even if rates begin to fall, they're unlikely to return to the ultra-low levels that fueled Australia's last decade of rapid price growth. The cheap credit era was an anomaly, and when an entire nation builds its housing expectations on an anomaly, the adjustment becomes painful. A return to lower rates might offer relief, but it won't reverse the structural issues. The lack of supply, the collapse in construction, the extreme rental pressure, and the population growth outpacing housing completions. These problems don't disappear just because rates fall by a percentage point. Another major unknown is how many households are already close to breaking. We don't see their bank accounts. We don't see their credit card balances. We don't see the compromises they're making behind closed doors, but we see the symptoms. Falling consumer spending, rising hardship applications, growing demand for refinancing, extended loan terms, and shifting attitudes toward homeownership. People don't talk about these things publicly, but the numbers, behaviours, and subtle changes in the market reveal the story. Australia is not collapsing suddenly, it is eroding slowly. And slow erosion is often more dangerous because it gives the illusion of stability until the moment the system can't hold anymore. If the next 12 to 24 months bring sustained pressure, even if it's mild, the cumulative effect on households could be severe. Not dramatic in a headline sense, but devastating in a personal sense. More families falling behind, more investors selling, more renters priced out, more buyers giving up, more suburbs stagnating, more builders closing, more communities feeling the squeeze. This is how long-term crises form, not from single shocks, but from layered, relentless pressure that never fully releases. But this moment also brings clarity. It exposes the flaws that have existed in Australia's housing system for years. It highlights the vulnerability of relying too heavily on property as a retirement plan, an investment, a social expectation, or a cultural milestone. It forces governments, policymakers, investors, and households to confront the reality that the old model isn't sustainable and never was. Australia's housing market will eventually stabilise. They always do. But stabilisation doesn't mean returning to what existed before. A new normal is coming, and that new normal will be shaped by higher caution, more conservative lending, slower price growth, stricter regulations, and a deeper awareness of how quickly things can change. For younger Australians, this period might redefine what it means to succeed financially. Saving for a deposit will take longer. Buying a home will require more strategic planning. Renting may become a long-term reality for many. And families may need to adjust expectations that were based on a very different world. For older Australians, the focus will shift toward preserving financial stability rather than relying on rapidly rising property values. Many will rethink downsizing, selling, or leveraging equity. For investors, this moment will force a reassessment of risk. Some will leave the market entirely. Others will adapt, choosing safer, more stable options. And some will take advantage of the opportunities that come during transitions like this. What matters most now is understanding that Australia's housing market is not experiencing a temporary setback. It's experiencing a transformation, a slow, grinding change that requires careful attention and thoughtful decisions. And through all of this, one thing remains certain. Millions of Australians are navigating this moment together. Families, couples, singles, renters, owners. Everyone is feeling the pressure in different ways. Everyone is adjusting, adapting, and hoping for stability. The path forward won't be easy, but the more clearly we see what's happening, the better prepared we are for whatever comes next. This is a pivotal moment in Australia's housing history, and the consequences will shape the country for years to come. Australia's housing market isn't collapsing overnight. It's breaking down piece by piece, quietly, slowly, steadily. And that breakdown is already rewriting the future. This is Aussie Watch, and I'll continue tracking every shift, every warning sign, and every development as this crisis unfolds. Please hit the subscribe button, it means a lot to me.